Welcome to the channel. Today we will talk about how the wealthy legally reduce taxes. Stay tuned. Taxes are one of the few things almost everyone in society shares. Whether someone earns a modest paycheck or runs a global corporation, taxes touch nearly every financial decision. Yet there is a growing perception that wealthy individuals and large corporations often pay far less in taxes than the average worker. This idea has sparked debates across the world. Some people believe the system is unfair. Others argue that wealthy individuals simply understand the rules better and structure their finances more efficiently. The truth lies somewhere in between. The wealthy rarely evade taxes illegally. Instead, they often rely on something much more powerful, the legal structure of the financial system itself. Modern tax systems are complex frameworks filled with incentives, deductions, and strategic opportunities. Those who understand these systems can legally reduce the amount of tax they owe, sometimes dramatically. In this exploration, we will examine how this works. Not through secret loopholes or illegal schemes, but through the legal mechanisms that exist inside the tax code. To understand how the wealthy reduce taxes legally, we must first understand an important distinction: the difference between income and wealth. Most people earn money through income. They receive a salary, hourly wages, or payments for services. This type of money is typically taxed immediately. Income taxes apply as soon as earnings are received. For workers who depend primarily on wages, avoiding taxes becomes extremely difficult because the money flows directly through systems designed to collect taxes automatically. But wealth often works differently. The wealthy frequently generate money through assets rather than wages. Assets include things like businesses, stocks, real estate, intellectual property, and investments. These assets often increase in value over time. But here is the key point. In many tax systems, increases in asset value are not taxed until the asset is sold. This concept is known as capital gains taxation. If someone buys an asset for $100,000 and it later becomes worth $1 million, they have gained $900,000 in wealth, but they typically do not pay taxes on that gain until they sell the asset. As long as the asset remains unsold, the gain exists mostly on paper. This allows wealth to grow for years or even decades without triggering immediate taxation. This is one of the foundational mechanisms that allows wealthy individuals to manage their tax exposure. But capital gains taxation is only one part of the picture. Another strategy often used by wealthy individuals involves borrowing instead of selling assets. This strategy is sometimes summarized with a phrase used in financial circles: buy, borrow, die. The idea works like this. First, wealthy individuals accumulate assets that grow in value. Instead of selling those assets and triggering taxes, they borrow money using those assets as collateral. Banks are often willing to provide large loans to individuals who hold valuable investments because those assets reduce the lender's risk. The borrowed money can then be used to fund lifestyle expenses. Since loans are not considered income, they are generally not taxed. This means individuals can access liquidity without selling their assets. Meanwhile, the assets themselves may continue to increase in value. Over time, this process can be repeated. The final part of the strategy occurs when the assets are eventually transferred through inheritance. In many tax systems, inherited assets receive something called a step-up in basis. This means that the value of the asset is reset to its current market price at the time of inheritance. As a result, much of the accumulated capital gain that occurred during the original owner's lifetime may never be taxed. This combination of borrowing and inheritance rules can significantly reduce the tax burden across generations. Another major tool used by wealthy individuals involves business ownership. Many high-income individuals structure their activities through companies rather than earning income as employees. Businesses can deduct a wide range of expenses before calculating taxable profit. These expenses may include salaries, equipment, travel, research, office costs, and other operational expenses. This means that taxes are often calculated only on the remaining profit after expenses are subtracted. In contrast, Employees typically receive income that is taxed before most personal expenses can be deducted. Business ownership also provides flexibility in how income is distributed. Owners may receive income through salaries, dividends, or retain profits inside the company. Each method may have different tax implications depending on the jurisdiction. By carefully structuring these flows, it is possible to optimize tax outcomes legally. Real estate offers another powerful set of tax advantages. Many tax systems encourage real estate investment through policies designed to stimulate housing development and infrastructure growth. One of the most important benefits is depreciation. Depreciation allows property owners to deduct a portion of the property's value each year as a non-cash expense. Even if the property is actually increasing in market value, depreciation may reduce the taxable income generated by the investment. This means that a property can produce real cash flow while reporting little or no taxable profit. In addition, some tax systems allow investors to defer taxes on real estate gains through mechanisms such as exchange programs. These exchanges allow investors to sell one property and reinvest the proceeds into another property without immediately triggering capital gains taxes. This allows wealth to continue compounding without interruption. Another important factor in legal tax reduction involves tax-advantaged accounts and structures. Retirement accounts, trusts, charitable foundations, and other financial structures can provide significant tax benefits. For example, retirement accounts often allow investments to grow tax-deferred for many years. Trusts can be used to manage assets across generations while reducing certain types of taxation. Charitable foundations allow individuals to donate assets while receiving tax deductions. These structures are not exclusive to the wealthy, but they often require specialized knowledge and long-term planning, which wealthier individuals are more likely to access. Corporate structures also play a major role in global taxation strategies. Large multinational companies often operate across many countries. Different jurisdictions have different tax rates and rules. By structuring operations across multiple regions, companies can sometimes allocate profits in ways that reduce overall tax exposure. This practice is often referred to as tax optimization. It operates within legal frameworks, but has become the subject of ongoing policy debate around the world. Governments periodically update tax laws to address these strategies, but the complexity of global finance means that the system is constantly evolving. Another powerful principle used in tax planning is timing. Taxes often depend not only on how money is earned, but also on when it is realized. By controlling the timing of asset sales, income distributions, or investment transactions, individuals can sometimes reduce the taxes owed in a given year. For example, selling an asset during a year with lower income may result in lower tax rates. Delaying income recognition may also shift taxation into future periods when rates are different. This flexibility allows careful financial planning to influence tax outcomes over long time horizons. Another aspect of legal tax management involves location. Different countries have very different tax policies. Some jurisdictions impose high taxes on income, but lower taxes on capital gains. Others have no income tax at all. As a result, some wealthy individuals relocate their legal residence to regions with more favorable tax environments. This practice, sometimes called tax residency planning, is legal but controversial. Governments often establish residency rules to determine who must pay taxes within their borders, but individuals with global mobility may choose where they live based partly on tax considerations. Technology and globalization have made this strategy increasingly feasible for certain individuals. Yet it is important to recognize that not all tax strategies are available to everyone. Many of the legal methods used by wealthy individuals depend on ownership of assets, businesses, or investments. People who rely primarily on wages often have fewer options for tax planning. This structural difference contributes to the perception that the tax system treats different forms of income differently. In many countries, wage income is taxed more heavily than capital gains or investment income. These policies were originally designed to encourage investment and economic growth, but they have also shaped the way wealth is accumulated and preserved. Another factor is access to professional expertise. Tax law is complex. Navigating it effectively often requires accountants, attorneys, and financial advisors. These professionals help structure investments, businesses, and estates in ways that comply with regulations while minimizing tax obligations. While the rules themselves are public, understanding how to apply them effectively often requires specialized knowledge. This knowledge gap can create differences in outcomes between individuals with different levels of financial sophistication. It is also important to note that tax laws are constantly evolving. Governments regularly adjust policies to close loopholes, encourage certain types of investment, or address inequality. Public debates about taxation often focus on questions of fairness, economic growth, and social responsibility. Some argue that lower taxes on capital encourage entrepreneurship and investment. Others argue that the system should collect more revenue from the wealthiest individuals. These debates shape the future of tax policy. But regardless of the political outcome, one principle remains constant. Tax systems are built with incentives. Governments use tax policies to influence behavior. They encourage home ownership, retirement savings, business investment, charitable giving, and innovation through tax incentives. Wealthy individuals often pay close attention to these incentives and structure their financial activities accordingly. In many cases, they are simply following the incentives built into the system. This highlights an important point. Legal tax reduction does not necessarily mean breaking the rules. It often means understanding the rules deeply and organizing financial decisions around them. For individuals interested in improving their own financial strategies, the key lesson is not necessarily to replicate the exact tactics used by billionaires. Instead, the lesson is to understand how different types of income and investments are taxed. Financial literacy plays a major role in long-term wealth building. Understanding concepts such as capital gains, tax-deferred growth, deductions, and asset ownership can dramatically influence financial outcomes over time. Even small improvements in tax efficiency can compound over decades. Ultimately, taxation is one of the most powerful forces shaping economic behavior. It influences where people invest, how businesses operate, and how wealth is transferred between generations. The wealthy often appear to pay less tax, not because they operate outside the system, but because they structure their finances in ways that align with the system's incentives. Understanding these mechanisms reveals something deeper about modern economies. The tax code is not just a set of rules. It is a map that rewards certain financial behaviors and discourages others. Those who learn to read that map can navigate the system more effectively, and in doing so, they often reduce their tax burden legally while continuing to grow their wealth. The question that remains is not only how the wealthy avoid taxes legally, but whether the rules of the system should evolve as economic realities change. That debate will likely continue for many years, but the principles behind wealth, taxation, and financial structure will remain central to understanding how money flows in the modern world. And for anyone seeking to understand the mechanics of wealth, the tax system is one of the most important places to start. If you liked the video, please share and subscribe for more informative content. Thank you for watching.